Welcome back. Today we are broadcasting from the Longview News Desk. Feel like a newsman today. Got a little bit different format we're trying here. Today is Chapter 9, and Chapter 9 actually has 3 videos, and this first video is just an introduction. Introduction to accounts receivable. Chapter 9 is dealing with accounts receivable, and we've already dealt with accounts receivable, and you know what it is. But today's topic is dealing with bad debt and accounts receivable. Anytime companies sell on account, in other words, they go ahead and deliver the goods and the services, customers going to pay us later. Anytime we do that, you know that inevitably we are going to have some bad debt. Now, companies, before they extend credit or sell on account, they're going to check the credit worthiness of their customer. And if they feel like the potential customer is not credit worthy, in other words, that there's a good potential that that customer will not pay their debt, then we just simply will not extend credit. We'll say cash only. But if they check out and they're credit worthy, then we will go ahead and extend credit to the customer and sell to them on account, where we debit accounts receivable and credit sales. And no matter how much we check out the company, we are still going to have some bad debt. And our problem from an accountant's point of view is we have to decide how are we going to account for these bad debts, these customers that don't pay us, and after a period of time we determine they don't have the worthiness to pay us, they don't have the ability to pay us anymore. Well, how do we account for that? There's a couple different ways. One method is called the direct write-off method, and it's the easiest method. And all you do there is when you determine that a customer cannot pay you back, you simply write them off at that point in time, whether it be on October 28th or whether it be on March 3rd or whenever it may be. It doesn't have to be the end of the accounting period. Whenever you determine that customer does not have the ability to pay their accounts back to us, then we write them off. And we write them off by debiting bad debt expense. Well, and then credit the accounts receivable. Got a problem with this, and we'll move to the next slide here. This direct write-off method violates the matching principle, an extremely important accounting principle, the matching principle. And as you recall from back in Chapter 2, the matching principle says that when we record revenue in a period, we also need to record any related expenses in the same accounting period. Well, let me give you an example or a scenario of how we can violate, we could possibly violate the matching principle. Let's say on December 15th, we make a sale to a customer, $1 million sale. We debit accounts receivable and we credit sales. So that's a revenue account. Sales is a revenue account. Of course, accounts receivable is an asset account. We're showing that on December 15th. Let's say it was in the year 2010. Okay. Customer owes us the money in 30 days. 30 days later, customer doesn't pay us. We go on back and forth, and let's just say October 28th of 2011, we determine that customer cannot pay us. Maybe they've gone bankrupt, they have no assets, and we're not going to receive that $1 million. Well, using the direct write-off method, we would on that date, October 28th, 2011, we would debit bad debt expense, and we would credit accounts receivable. Well, did you see how we just violated the matching principle? We recorded the revenue in the year 2010. I think I said December 15th, 2010. We waited till 2011 to record the bad debt expense. So we violated matching. We showed revenue in one period, expense in the next. We cannot do that, particularly if we have a significant dollar amount of bad debt. If we do not have a significant amount, then we can use the direct write-off method. But for companies that regularly sell on account, they cannot use the direct write-off method, and they have to use one of 2 other methods I've listed on the next slide here. They have to use either the percent of sales method or the percent of receivables method. And those 2 methods will be explained in the next 2 videos.